Hello, and welcome to the first lecture of the highly regarded university. After reading about 100 times the normal amount of WallStreetBets posts than I usually do in the past 4 weeks, I think some of you would benefit from a video like this. Okay, probably most of y'all. So in this video, I'm going to teach you the basics of gambling. And whether you've been a long-time participant of the financial markets or you're just a complete noob, all of y'all should benefit from this video. After all, mastering the fundamentals and having a solid foundation is what differentiates someone who's good versus someone who's great. You don't want to be the guy that's missing free money. So hopefully by the end of this video, you'll learn a thing or two to help you make some money or at least lose less of it. Before I start, I know some of y'all might get offended that I'm calling you a gambler for participating in the financial markets, since the term is mostly associated with degens gambling their money away on playing cards and betting on what color a ball will land on a spinning wheel. The world of finance is very similar, and the truth is every single decision we make in life is a gamble, so there's no need to be offended. We're all gamblers. For example, going to your job at Wendy's, gambling. Meeting someone on Tinder, gambling. Assuming that SPY will continue to average 10% annually, gambling. Even though we're technically gambling, unlike the casino where the house basically always wins, the financial markets have instruments or different games that you can play with different strategies that you can actually come out ahead. In fact, most of you already know about the buy and hold strategy with financial instruments like ETFs or mutual funds that track indices like the S&P 500. So most of you investors already know winning strategies exist, but when you try other strategies, you fail because you're just terrible at gambling. In this video, we'll cover the following: the basics of probability and gambling, the gambler's fallacy and expected value, psychology and position sizing for gambling. Since some of y'all might have forgotten basic probability, I'm just going to quickly cover some of the basic concepts to refresh your memory. Let's start with a fair coin. This means that the coin has a 50% chance of heads and a 50% chance of tails. If I flip this coin one time, there's an equal chance of the coin landing on head or tail. Simple, right? Now, what if I flip this coin 10 times? You might think that it would be a perfect 5 heads and 5 tails, but that's actually unlikely. What we can expect over a large number of flips is to get close to 50% heads and 50% tails. With 10 flips, we might get results like 7 tails and 3 heads, or even an extreme case like 10 tails and no heads at all. But if the coin was truly fair, the more we flip the coin, the closer we should get to 50% heads and 50% tails. This is called the law of large numbers. To summarize what this means, the more trials we do, or in this case the more flips we do, the closer to the expected outcome we'll get. In other words, if our coin was truly fair, we should approach the 50% heads and 50% tails as we increase the number of flips. Now, if it so happens that we run this experiment 10,000 times or 100,000 times and we don't approach the 50-50 and instead we approach 60% heads and 40% tails, then we know that we were lied to and the coin is actually not fair. How does this relate to gambling? Well, imagine you went to the casino every single night and watched people play roulette at the same table for a month, and you kept track of how many times it landed on red, black, and green. In traditional American roulette, there are 38 slots, 18 red, 18 black, and 2 green. If the roulette was fair, the chance of landing on red is 47.37%, and the chance of landing on black is also 47.37%, and the chance of landing on green is 5.26%. Most people gambling should know what the theoretical probability is to land on each color, and in most cases, if they see that the recent spins at a roulette table landed on black, they'll start betting on red thinking that the odds will revert back to its true probability. However, based on the data that you collected over the month, that specific roulette table actually had 60% of its spins land on black, 35% land on red, and 5% landing on green. Let's just assume that you observed enough spins within the month, like 10 to 50,000, you basically prove that the table is not fair at all, and you should always bet on black since you have a 60% chance of winning. Going back to the coin flipping example earlier, one important thing to understand about flipping a coin is that each flip is independent. This means that each flip's result doesn't depend on the previous one. Even if you flipped heads 5 times in a row, the next time you flip the coin, the probability of it being heads is still 50%. Likewise, in theory, a roulette spin should be designed to be independent. This is where the gambler's fallacy comes in. People sometimes think that if something happens a lot in a row, the opposite is more likely to happen next. But for independent events, that's just not true. The simplest example of a dependent event is a deck of 52 playing cards. If you draw one card without putting it back in the deck, like the Ace of Hearts, the probability of drawing another ace decreases since there are now only 3 aces left in the deck. In a real casino, they'll use multiple decks together to make it much harder for the average person to count the cards. Now, let's go over some examples of independent and dependent events in the stock market. Independent events, or at least mostly independent events, are things like uncorrelated assets. As an example, the performance of a gold mining stock would have very little direct influence on the daily returns of a tech stock like Microsoft. For dependent events, we have the opposite, which are correlated assets. For example, if the semiconductor industry becomes really bullish due to AI hype, there's a high likelihood that stocks like Nvidia, AMD, and TSMC to go up together. Another example of dependent event is index movements. If a large company in the S&P 500 like Microsoft starts tanking, it'll definitely cause negative pressure onto the price of SPY and vice versa. These are just some very simple examples to give you an idea, but the most important takeaway is to be able to differentiate if something is an independent event or if it's a dependent event. The last thing you want to do is treat each trading day as an independent event, ignoring what the market has been doing in the past days, weeks, or months. I'm sure you've heard of the phrase, follow the trend. And you also need to avoid the gambler's fallacy, which is essentially trying to time a reversal in this case. Now, let's talk about gambling and expected value. Let's assume that we wagered on a coin flip. For the first example, we can assume that the coin is fair, and if it lands on heads, I win $10, and if it lands on tails, I lose $10. We use a simple formula to calculate the expected value, or in other words, the average outcome of this bet over many trials. In this case, the expected value is 0, which means that I shouldn't expect to make or lose any money. I'm basically just wasting my time playing this game. Now, let's make it more interesting and say that I win $20 if it lands on heads and lose $10 if it lands on tails. Now, our expected value, or EV, is 5. Which is good because a positive EV means that I actually have some type of edge in this game, and if I play it enough times, I should expect to make money. If the coin wasn't fair, and the reward of me winning was only $15, let's say there was a 35% chance of landing on heads and 65% chance of it landing on tails, the EV would be negative 1.25, so over time if I kept playing this game over and over, I would expect to lose money. Now, going back to the law of large numbers, even though one of the previous bets we covered would net us a positive EV, this doesn't mean that you should YOLO all of your money into the single bet or trade. It just means that over time, if you make a bunch of smaller bets, you'll come out ahead, but there are no guarantees that one specific trade would make you profit even if your strategy has an enormous edge. So even if you found the best strategy, you need to stop impulsively YOLOing your entire portfolio, especially on short-dated options. Obviously, the real world is a lot more complicated than simple coin flips or roulette tables, and the true probability of a trade in the stock market is not exactly known, and the simple law of large numbers relies on the fact that the events are independent, which is not always the case, but hopefully you at least get the general idea. Position sizing is probably one of the most difficult things for retail traders, because all of us trade like we want to retire immediately tomorrow. Now, this part really depends on your risk tolerance and strategy, but generally you probably don't want to spend more than 3% of your portfolio in a single trade. If you truly have a good strategy, this will compound pretty quickly anyways, and I know it sucks because you won't get that dopamine hit of full sending your portfolio, but you're going to win some and lose some, and you really want the probability of your trades to play out. If you're lucky enough to find some type of strategy or edge to beat the market, it's going to be boring. It's probably the same reason why you wanted to try some strategies on your own in the first place, because index investing is like watching paint dry.